Welcome. You're viewing the video version of the weekly Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for March 6th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.83 rose from 0.91 last week and is now in strongly bullish territory. The total count of securities in bullish or bearish patterns rose 8% to 3,201. The count of bearish stocks decreased 27%, while the count of stocks in bullish patterns increased 47%. The Pirls P&F Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, clicking Register, and following the prompts. To receive the email version of the Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 380 points for the 17th advance in 27 weeks. At a negative 172.41 points, it continues below all 6 tops above plus 100, has now risen above the May 2014, July 2014, and January 2015 bottoms, and is now above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 5 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on lower average daily volume. Momentum. At Thursday, 2:25, the CCI 20 daily formed a zero-line reject long entry signal within the plus or minus 50 range. Monday, 2:29, it declined but remained above the zero-line reject pivot, so we stay in the trade as it rose above plus 100 for the remainder of the week. We will continue to follow the results of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 3 weeks ago, while the daily CCI 20 began a Woody's downtrend 1 week ago. The CCI 20 weekly continues in a Woody's trend down. It rose last week to a negative 36.29, now within the plus or minus 50 range for a valid zero-line reject short entry signal if it falls next week. Industry rotation the last 2 weeks. All of the top 5 and bottom 5 industries are positive. Bullish, Brokers has entered the top 5. KBW Bank has left the bottom 5. Bearish, Comp Tech has entered the bottom 5. Networkers, semis, computer hardware, and disk drives have left the top 5. Gold and silver has left the bottom 5. Focus this week from www.zerohedge.com. Is the bear market over already? by Lance Roberts via realinvestmentadvice.com. The bottom line is that there is a lot of evidence that the current bull market is merely a bear market rally. The following are some key points and charts. The markets were not only able to push into the 1970-1990 level last week. The 8% advance from the closing lows just 4 weeks ago has sent shorts scrambling to cover, pushing stock prices sharply higher. Portfolios have been grossly underweight equity-related exposure since April of 2015, creating a positive performance gap between the index and the portfolio. That positive performance gap allows for a more relaxed approach to increasing portfolio allocations when the market reestablishes a positive price trend without sacrificing long-term performance. But given that risk is still prevalent to the downside, I am willing to give up a potential bear market rally for the sake of protecting client capital from loss. As I have stated before, when the market reestablishes a positive trend, I will recommend putting preserved capital back to work. However, for such an equity increase to be warranted, the market will need to break the current declining price trend and work off some of the currently extreme overbought conditions. This is shown in the updated chart from last week. There are quite a few moving pieces here, so let me explain. With the oversold condition now exhausted, the potential for further upside has been greatly reduced. The arching dashed red line shows the change of overall advancing to now declining price trends. The signal to increase equity-related exposure in portfolios will require a breakout above the currently negative price trend. Until that happens, we remain confined in a bear market. Time to buy oil/energy? The short answer is no. Let me explain. First, the rally in oil prices is a short covering extreme oversold move. While it seems like it has been a massive surge in the short term, as shown in the chart below, it barely registers on a longer term basis. It is always important to keep some perspective. The decline in oil is not complete as of yet, as there has been little progress in reverting the supply-demand imbalance. This will take several years to rectify, and oil/energy prices will eventually settle into a trading range at these lower levels. As shown in the chart below, the number of outstanding contracts on oil is still well above the long-term mean, suggesting that more unwinding needs to occur before a longer-term bottom in oil prices is made. Note, if you don't think housing is about to become a problem again, this piece by Aaron Lehman should give you a wake-up call, as interest-only mortgages are back. It is completely understandable that after sectors like energy, materials, and industrials have had big declines, that trying to bet on a bottom is enticing. However, that is the equivalent to gambling without looking at your cards. There is now little for us to do except to wait and watch patiently for the market to either confirm a bear market or stabilize and begin to rebuild the bullish supports necessary to allow equity risk to once again be increased. Neither situation will make itself apparent in short order, so we relax and let the market dictate what actions we take next. While very short-term indicators have improved, the longer-term signals have not. Thank you for viewing this week's Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, looking forward to some warmer weather in the near future, and that you are also looking forward to a prosperous and productive week coming up. And wishing you, as always, true success.